Welcome to my channel. I am going to walk you through the process of valuing 6 oil and gas midstream companies and analyzing their financial ratios. Become a member of the channel for as little as 99 cents or as much as $99. If you do the $99 option, we could do a private Zoom session and discuss financial statements. See the link in the very top of the description. The first company we're going to look at is DCP Midstream. Midstream refers to points in the oil production process that falls between upstream and downstream. Midstream activities include the storage, processing, and transportation of petroleum. DCP is a master limited partnership. MLPs usually do not pay taxes. The way they avoid taxes is they have to distribute at least 90% of their profits as dividends, and the investors who receive the dividends pay taxes. Regular corporations have to deal with double taxation, where they get taxed on their profits, and then the dividends are distributed, and the investors pay taxes again. To qualify for MLP, the business must receive 90% of its revenue from natural resources or real estate. An MLP issues units instead of shares, so MLPs have no equity. The way I figure out the equity to calculate some of the ratios is I take the total assets minus total liabilities. Let's get started with the model. This is a mid-cap company, 2.3 billion market cap. They're trading at $11.03 a share, and they have 209 million shares outstanding. The way you could calculate shares outstanding, it's market cap divided by stock price, gives you shares outstanding. We're going to need this number later when we calculate the value of the company. Let's look at the financials. Free cash flow is how you value a company. You estimate the future free cash flows and then discount that back to today's dollars. That's what we're doing in this video for each company. And free cash flow is cash flow from operations minus capital expenditures. If a company has free cash flow, then it could pay down debt, it could pay dividends, it could acquire other businesses, or it could invest back into their business to grow it. If a company has negative free cash flow, it might not be able to do any of those things. If a company has positive free cash flow, that means it's generating more cash than it's spending. This company has positive free cash flow each year, which looks good. It's a little bumpy, but as long as it's positive, that's a good sign. Net income is the profit or loss on the income statement. It's revenue minus expenses. And this company has positive net income in 3 years. Then they have a negative in 2019, but they have positive free cash flow. A lot of things can occur for a company to have negative net income and positive free cash flow. If a company uses accounts payable a lot, it will book expenses onto the income statement, which brings down its net income. But free cash flow is not affected because you don't pay any cash. In the future, you pay cash. That's just one thing that can occur. But if a company purchased an asset in the fourth quarter of 2019 and booked the expense onto the income statement but didn't pay for the asset until 2020, that could be another reason net income is negative and free cash flow is positive. Their revenue grew a lot, 1.5 billion to 7.6 billion. That's pretty amazing. It did drop from 2018 to 2019, but it's a really big increase from 2016. Let's look at a capital structure. $5.9 billion of debt. They pay 5.1% interest on their debt. Since they don't pay taxes, that's the cost of debt. 47% of that capital structure is debt, which means 53% is equity. Cost of equity is 32%. We use the capital asset pricing model to figure that out. And part of the CAPM formula is the beta. The beta is how volatile the stock is relative to the market. And this is a really high beta, 3.83. So the stock moves about 4 times the market, so it's really volatile. The higher the beta, the higher the cost of equity. And their WACC is 19.19%, which is a blend of the cost of debt and cost of equity. So the WACC is the discount rate companies use to figure out if they want to take on a project or not. If they wanted to take on a new project or a new venture, they would estimate the future free cash flows that project will generate and then discount it back to today using the weighted average cost of capital, and then decide if that particular project was going to add value to the company. The WACC is the discount rate we're going to apply to the future free cash flows for this discounted cash flow model. We estimated 4 years of free cash flows. We also estimate a terminal value, which is all cash flows past year for, that's $2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.7 billion. We divide that by 209 million shares. And we get a calculated stock price of $8.10. It's trading at $11, so it's trading at a 36% premium. It's a sell according to the model. Simply Wall Street values this company at $19, so they're saying the stock is 42% undervalued. A strong buy. Let's see where the stock has been trading at the past few years. The stock peaked in the low 40s, but it's come down quite a bit since coronavirus hit. It's come up a little bit since the bottom, but it looks like it could be overvalued, but it's a really volatile stock, so you might be able to get in and out and make a quick profit, but you have to time it right. Let's look at the financial ratios. They have a negative PE. The median is 16.5. The average for the entire market is 18.5. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15. They're at negative 14.4 because they have negative net income. Price to sales is really good. The median for the market is 2.0. The average is 4.7. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5. They're at 0.3. So investors are paying 30 cents for $1 of revenue. That's a really good ratio. Price to book is also really good. The median is 2.3. The average is 4.9. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5. They're at 0.3, so investors are paying 30 cents for $1 of book value. Equity is total assets minus total liabilities on the balance sheet. They don't have a good interest coverage ratio. The median is 4.0. The average is 13.3. Interest coverage ratio is EBIT over interest expense. I like to see above 2. They're only at 0.6, so they cannot cover their interest payments with their operational income. EBIT stands for earnings before interest and taxes. It's on the income statement. It's called operating income. ROE is bad. The median is 12%. The average is 15%. ROE is net income over equity. I like to see above 20%. They're at negative 2%. Current ratio is not good either. Median is 1.3, the average is 1.8. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2. They're at 0.6, so they cannot cover their current liabilities, so they need to take on more debt. The best way to look at ratios is to compare them to similar companies. I've done videos on Antero, DHT, Enbridge, Enterprise, Energy Transfer, Euronav, Frontline, Green Plains, Interpipeline, Kinder Morgan, MPLX, Noble Midstream, ONEOK, Plains, PBF, Pembina, Teekay Tankers, Teekay LNG, and the Williams Companies. All in the same industry as DCP. And if DCP has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So of course they're worse in PE because they're negative. They are better than average in price to sales. They have the best price to book ratio of all the companies. They're lower than average in current ratio, negative ROE. They are doing better in debt at 47%, average is 55%. They're a bit lower in market cap at 2.3 billion, average is 12 billion. The biggest company is Enbridge. When I convert them to US dollars, that's 61 billion market cap. DCP has a 15% dividend yield, so they do pay a high dividend in an industry that pays really high dividends. The average is 12%. So to summarize, I have them trading at a 36% premium. Their ratios look pretty bad, and their financials are decent. The next company we're going to look at is Green Plains, another oil and gas midstream company. They have a market cap of $166 million, so they're a micro-cap company. They're trading at $7.15 a share, and they have 23 million shares outstanding. Their financials look really good. Everything is positive and consistent from year to year. That's what you want to see when you invest in a company, positive and consistent. Consistent is the most important thing, because if it's not consistent, then you have no idea what to expect. And their margins are really good. 49 to 54%. Net profit margin is net income divided by revenue. It's how well you convert revenue into profit. The higher your expenses, the lower your net income and the lower your net profit margin. So this company is doing a good job converting revenue into profit. They're managing their expenses well. They have $132 million of debt. They have negative equity, which means their liabilities are greater than their assets. They pay 6.29% interest on their debt. That's the cost of debt. They're 100% debt since they have negative equity. They do have a low beta, 0.86, so the stock moves less than the market. But their WACC is the cost of debt, 6.29%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimate a terminal value, which is all cash flows past year 4. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $310 million. We divide that by 23 million shares. And we get a calculated stock price of $13.34. They're trading at $7.15, so they're trading at a 46% discount. It's a strong buy according to the model. Simply Wall Street's even higher. They're at $18.29 a share, so they're saying the stock is 61% undervalued. Let's see where the stock has been trading the past few years. It was trading in the low 20s, and then it dipped a little. Then it took a real dive in March, like most stocks did. It's come up a little bit, but it seems like a really undervalued stock that has solid financials. Let's look at the financial ratios. Great PE and price to sales, and a bad price to book. PE is stock price over earnings per share. They're at 4.1, which is really good. Price to sales is stock price over sales per share. They're at 2.0. That's great. Price to book is stock price over book value per share. They have negative book value, so they have negative price to book. Really good interest coverage ratio, that's EBIT over interest expense. They're at 5.9. They have negative ROE, so we can't look at that. Current ratio is terrible, that's current assets over current liabilities, so they can't even come close to covering their current liabilities. The best way to look at ratios is to compare them to similar companies. I've done videos on 19 other oil and gas midstream companies. Green Plains is here in the middle. If Green Plains has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're better in PE, but they're worse in everything else. So they don't look so great in their ratios. 100% debt. They have a 7% dividend yield, which isn't terrible, but it's a lot lower than the average. They're really small. They're the smallest company on this list at 166 million market cap. To summarize, I have them trading at a 46% discount. And the reason it's a discount is because the stock price has come down so much. So just because a company has poor ratios doesn't mean it's overvalued. You have to look at where it's trading at. They do have terrible ratios relative to their peers. But their financials look really good. But they may go bankrupt, so it doesn't mean much if their financials are good. The next company is Inter Pipeline. We're going to look at the ticker trading on the Toronto Stock Exchange, but they also trade in the pink sheets in the United States. Also an oil and gas midstream company. Market cap 5.8 billion Canadian dollars. They're trading at $13.62 a share, and they have 426 million shares outstanding. Free cash flow looks okay. It's positive for 3 years, then they had a big negative in 2019. They might have been investing in that company that year. Net income looks really good. It's positive and growing. Revenue looks really good, 1.8 billion to 2.5 billion. The margins are okay, 21 to 25%. They have $6.6 billion of debt. They pay 2.66% interest on their debt. Cost of debt is 1.95%. And they have 62% debt in their capital structure, which means they have 38% equity. Cost of equity is 20.29%, and we need the beta to figure that out. And they have a pretty high beta, 2.34. The stock moves more than 2 times the Canadian market, and their WACC is 8.94%, which is a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimate a terminal value, which is all cash flows past year 4, at 6.3 billion Canadian dollars. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $6.3 billion. We divide that by 426 million shares. And we get a calculated stock price of $14.87. They're trading at $13.62, so they're trading at an 8% discount. It's a buy according to the model. Simply Wall Street also has them undervalued at $16.52 a share. Let's see where the stock has been trading at the past few years. So the stock was trading in the low 30s for a few years, then took a dip. It's come up a little bit, but it looks like it could be a good value. Let's look at the financial ratios. Great PE and great price to sales and price to book. PE is stock price over earnings per share. They're at 10.8. Price to sales is stock price over sales per share. They're at 2.3. And price to book is stock price over book value per share. They're at 1.4. Good interest coverage ratio, that's EBIT over interest expense, they're at 3.9, so they can easily cover their interest payments. ROE is a little low, that's net income over equity, they're at 13%. Current ratio is really bad, that's current assets over current liabilities. They're only at 0.1. They can only cover about 10% of their current liabilities. The best way to look at ratios is to compare them to similar companies. I've done videos on 19 other oil and gas midstream companies, and Inter Pipeline is here in the middle. And if Inter Pipeline has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they are worse than everything except price to book ratio. They're a lot better than average. They're at 62% debt, average is 55%, so they're not that much worse than debt, but their dividend yield is real low, 3.67% compared to the average of 12%. To summarize, I have them trading at an 8% discount. Their ratios look really weak, but their financials are okay. The next company we're going to look at is Teekay LNG Partners, another oil and gas midstream company, small cap, under 1 billion market cap. They're trading at $10.34 a share, and they have 87 million shares outstanding. Free cash flow looks really bad. It's negative in 3 to 4 years. Net income is okay, although it's pretty small in a couple of years. Revenue looks good though. It's growing each year. They have $1.8 billion of debt. They pay a hefty 9% interest on their debt, and that's the cost of debt. They have 49% debt in their capital structure, which means they have 51% equity. Cost of equity is 13.5%. Their beta is 1.45, so the stock moves about 1.5 times the market. So it's a little volatile. It's not too bad. As long as it's below 2, I don't consider it too volatile. Their WACC is 11.25%, which is a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $1.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.6 billion. We divide that by 87 million shares. We get a calculated stock price at $18.72. They're trading at $10.34, so they're trading at a 45% discount. It's a really strong buy according to the model. Let's see what Simply Wall Street says. They're even higher. They're at $27 a share, so they're saying the stock is way undervalued. Let's see where it's been trading the past few years. So this stock is a lot more steady than the previous ones we looked at. It did peak almost $30 5 years ago, and it took a dive, but since then it was fairly steady, and even at coronavirus, it didn't take a huge dip, a little dip, and it's come back up. So let's look at the financial ratios. Great PE, price to sales, and price to book. PE is stock price over earnings per share, they're at 7.2. Price to sales is stock price over sales per share, they're at 1.5. Price to book is stock price over book value per share, they're at 0.5. Interest coverage ratio is a little low, that's EBIT over interest expense at 1.8. I like to see above 2. ROE is also a little low, that's net income over equity. I like to see above 20%, they're at 7%. Current ratio is also a little low, that's current assets over current liabilities, so they cannot cover their current liabilities. The best way to look at ratios is to compare them to similar companies. I've done videos on 19 other oil and gas midstream companies, and Teekay LNG Partners is here. And if they have a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they are better in price to earnings, price to sales, and price to book. They are worse in current ratio and ROE. Debt, they're a little better in debt. They're a small company under 1 billion market cap. The average is 12 billion. The dividend yield is a little under 10%. The average is 12%. Some companies pay really big dividends, like DHT is almost 36%. To summarize, I have them trading at a 45% discount. Their ratios look pretty good, but the financials are a bit weak. The next company we're going to look at is Teekay Tankers, another oil and gas midstream company, market cap 361 million. They're trading at 10.72 and they have 34 million shares outstanding. Free cash flow is positive in 3 of the 4 years. Looks like they had a bad year in 2018 with negative free cash flow and negative net income. They have negative net income in 2 of the 4 years. Revenue looks like it's on the incline. It goes from 527 million to 944 million. Their debt is 610 million. They pay 10.7% interest on their debt. That's the cost of debt. Their capital structure is 38% debt, which means they're 62% equity. Cost of equity is only 2.86% because their beta is really low, 0.07, so the stock hardly moves relative to the market. Their WACC is 5.85%, which is a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 568 million. We discounted these numbers back to today using the weighted average cost of capital. We get a value of the company of $774 million. We divide that by 34 million shares. And we get a calculated stock price of $23. They're trading at 10.72, so they're trading at a 53% discount. It's a strong buy according to the model. Simply Wall Street's even higher at $34 a share. Let's see where the stock has been trading at the past few years. The chart indicates they were trading over $500 a share 5 years ago, but this is not accurate because they did an 8-for-1 reverse stock split in November 2019. When a company does a reverse stock split, it could make it really confusing looking at these charts. A reverse stock split is usually not a good sign. It generally means a company is trading so low they don't want to get delisted, so they do a reverse stock split to bring the stock price back up. Let's look at the financial ratios. Great PE, great price to sales, great price to book. PE is stock price over earnings per share, they're at 8.7. Price to sales is stock price over sales per share, they're at 0.4. Price to book is stock price over book value per share, they're at 0.4. A good interest coverage ratio, that's EBIT over interest expense, they're at 2.0, so they can cover the interest expense twice. ROE is weak. Net income over equity, they're only at 4%. They have a good current ratio, that's current assets over current liabilities, they're at 1.5. The best way to look at ratios is to compare them to similar companies. I've done videos on 19 other oil and gas midstream companies, and Teekay Tankers is here at the end. And if Teekay Tankers has a number in green, they're better than the average. If they have a number in red, they're worse than the average. They're about average at PE, a lot better in price to sales, price to book, and current ratio, much worse in ROE, better in debt, really low in market cap, and according to Yahoo Finance, they don't pay a dividend. They're 0% dividend yield. And the main reason people invest in oil and gas midstream companies is for the dividends. They're not investing for the appreciation of the stock. To summarize, they're trading at a 53% discount. Their ratios look pretty good, and their financials are a bit weak. The last company we're going to look at is the Williams Companies. This is a big company, 24.8 billion market cap. They're listed on the S&P 500, this company. They trade at $20.40 a share, and they have 1.2 billion shares outstanding. They have lots of free cash flow in 2016 and 2019. It's much lower in 2017 and 18. Net income doesn't look so great. It's negative in 2 years. But But as long as they have positive free cash flow, that means they're operating with more cash than they're spending. Revenue seems pretty good. It goes up a lot from 2016 and 2018, goes down a little in 2019, but $8 billion is a good number. They have $22 billion of debt. They pay 5.3% interest on their debt. Cost of debt is 3.65%, and they have 63% debt in their capital structure, which means they have 37% equity. Cost of equity is 16.37%. And their beta is a little high, 1.83, so the stock moves a little less than 2 times the market. Their WACC is 8.4%, which is a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We estimated terminal value, which is all cash flows past year 4, that's $14 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $14.4 billion. We divide that by 1.2 billion shares, and we get a calculated stock price of $11.85. They're trading at $20.40, so they're trading at a 72% premium. It's a sell according to the model. Simply Wall Street is in the other direction. They're valuing the stock at almost $22, so they're saying it's a buy. Let's see where the stock has been trading the past few years. The stock broke $40 a few years back, and it was trading in the 30s for a while, but it's been dipping, and it looks like it could be an undervalued stock according to my model, but anything can happen. It's a really big company, and investors tend to feel more comfortable investing in larger companies. And stock price has nothing to do with how well the company is performing. That's just a function of the stock price. The real value of the stock price is supply and demand of the market. If more people buy a stock, it pushes the price higher, even if the company is performing poorly. And if more people sell the stock, it pushes the price lower, even if the company is performing well. Let's look at the financial ratios. They don't have such a good PE, decent price to sales, but they have a good price to book. PE is stock price over earnings per share. They're at 29.3. These are the average and medians in the market. Price to sales is stock price over sales per share. They're at 3.0. Price to book is stock price over book value per share. They're at 1.9. Good interest coverage ratio, that's EBIT over interest expense. They're at 2.0. A low ROE, that's net income over equity. They're at 6%. Really low current ratio, that's current assets over current liabilities, only at 0.4. So that means they can only cover 40% of their current liabilities, which means they may need to take on more debt. The best way to look at ratios is to compare them to similar companies. I've done videos on 19 other oil and gas midstream companies. The Williams companies is here at the end, and if they have a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they all worse in price to earnings and price to sales. A lot better in price to book. Worse in current ratio, ROE, a little worse in debt. They are much better in market cap. They're the second biggest company of the bunch. Only Enbridge, a Canadian company, is bigger. An 8% dividend yield is really high, but in this industry it's low because the average is 12%. So to summarize, I have them trading at a 72% premium. Their ratios are decent and their financials are a bit weak. Leave a comment. I reply to everybody's comments. And become a member of the channel for as little as 99 cents to support the channel. Or you can pay $99 if you want to do a private Zoom session and we can discuss financial statements. See the link in the very top of the description. Thanks for watching.